Bismillahirrahmanirrahim. Today we will start our next topic that is related to valuation of debt and preference shares. So there is valuation is different for different debt instrument and preferred shares because debt instruments have different characteristics, and holding these kind of debt instruments is very important for the company, and they have to value those debt instruments in order to get the true value of these instruments, where we have different kinds of debt instrument and preferred shares, and we will discuss these one by one in the next slides. So before going through the detailed analysis and details discussion on all those debt instruments um, and preferred shares, we have to see the formulas for each one of them. And the formula for various types of finances are as follows. Number one, irredeemable debt without taxes. Irredeemable debt is the kind of instrument which will provide you return for unlimited time period, and you will not get the actual amount which is being invested in that debt, but you will get return on that instrument for unlimited time period. And if we want to value this irredeemable debt without taxes, so you don't have to deduct the amount of taxes from the interest rate, or so in this case the present value of this would be I is the return or percentage which you are getting from that instrument, divided by KD, that is the return on debt, the percentage. Then irredeemable debt with taxes is actually the same as the above, but in this case we have adjusted it for the taxes because it will because we have to adjust it for taxes. So the present value would be I multiplied by 1 minus taxes divided by KD. Then redeemable debt is the kind of debt instrument which will provide you some interest for annual interest, and pay you back the whole amount at certain time period, which is actually identified in the terms and condition of that debt. Maturity value is equal to present value of future interest and redemption receipt discounted at investor required return. We will see that what would be the return you are getting from these redeemable debts. There are almost two different kinds of irredeemable debts. One is discount debt, discount bond. That is the kind of bond will issue on a lower price, and at its face value, or when it matures, it will give you the 100% value of the of its face value. Then second one is your non-zero coupon bond. That non-zero coupon bonds are those kind of bonds or debts which will provide you interest for annually interest, and at the end of the maturity value it will provide you the whole amount which is invested and in that instrument. Then preferred shares, these are also no, the formula is for non-callable preference shares, and it is just like the formula which we have used for irredeemable debt, but the difference over here is we have taken the amount of dividend which is being paid on per period of time, divided by the return on preferred shares. So these are the formulas, and I have discussed, as there is another type of preferred stock which is called as callable preferred stock. So in that the value for callable preferred stock is that we will take the dividend per period, and the amount you will get back on the preferred stock, or after certain time period. We have to discount both of them, and then we have to calculate the value. In this formula, the P naught is for X dividend market value of the debt or share. I is annual interest starting in one period's time. KD is company's cost of debt expressed as a decimal, and KP is cost of preferred shares, or return on preferred shares. So how we can value our irredeemable debt, the debt which cannot be, which provide you return for unlimited time period. It is also called as a console or perpetual bond, because it will provide you return for unlimited time period. So a company which has issued an irredeemable loan notes with a coupon rate of 7%. If the required return of investor is 4%, what is the current market value of the debt? And the solution is simple. As we know that the coupon rate is 7%, so 7% is I, and 4% is KD. So 7 divided by 4% is equal to $175. So this is the value for this irredeemable debt which is being issued, and and it has a characteristic that it will provide 7% return, and 7% return, and 4% would be the cost of that debt. So the current market value of this debt is $175. Now, in case of redeemable debt, we can see this the help of this example. Like in this, a company has issued some 9% debentures, which are now redeemable at par in 3 years' time. Investor now require a redemption yield of 10%. What will be the current market value of each $100 of debentures? As when we look at to this debt instrument, so there are two kind of cash flows we are getting from this debt instrument. Like in one in which we can get if in each year, in a form of interest, and that would be $9 each in each period. And at the end of third period, we will get $100. That is the face value, or the of that debt. So we have to find out the present value of each cash flow. For first year, the cash flow value, that is $9, is had a present value of 8.18, because it would be discounted for one period. Second would be discounted for 2 periods, so that would be 7.43, and the third one would be discounted for 3 periods, that is 6.76. And the redemption value is $100, as you will get $100 after third period. So we will find out the present value of this $100. That would be done by 100 divided by 1.10 power 3, and we will get 75.10. So the total market value today of this debt is 97.47. Now, preferred shares. When we talk about the valuation of preferred share, so there is a problem, as preferred shares have the qualities of both stocks and bonds, and we cannot value these preferred stocks just like the common stock. Because the owner of shares are part owner of the company in proportion to the held stock, just like common shareholders. But they are just a hybrid security that combines some features of common stock with that of corporate stock, a corporate bond. Like because the dividend we pay on a preferred stock is a well defined identified amount, and it cannot be increased or decreased. And a certain time period, like when we talk about a cumulative preferred stock, so in that kind of preferred stock, the dividends is accumulated, and if you have the company has failed to pay the dividend of 1 year, it is being accumulated, and they have to pay all the dividends which has been accumulated in the previous period. But non-cumulative preferred stock has no this such kind of feature, but the dividend amount which they have to pay on preferred stock is a fixed amount. So when it's come to the valuation of preferred stock, it's quite different from a common stock. And when we are valuating preferred stock, there are two kinds of preferred stock. One is the preferred stock which is not which is not callable, like it will pay you dividend for unlimited time period. But the other the other kind of preferred stock is it has a callback option with it, and the company can call back this preferred stock in certain time period, which can be identified in the terms and condition of the of these preferred stock. So when it comes to the priority, so preferred stock also have priority over company's income, meaning they are paid dividend before common stocks and have priority in the event of bankruptcy or liquidation. So valuation techniques or valuation technique used in preferred stock is quite different from common stock. Now we can see the calculation of our preferred shares. This is an example of a preferred share which is irredeemable. So a firm has an issue of $100, 12% preference share. That means that you'll get 12%, 12% on $100 each year. Like that would be dollar 12 each year. And currently the required return of preferred share is 14%. So what is the value of preferred shares? So solution will be that as the when we are calculating of value or the present value of preferred share, which is irredeemable, so that is D divided by KP. D is the dividend amount, that is over here 12%, 12%, and for $100 it is $12, and KP, that is return on preferred share, is 14%. So we will divide $12%, we will divide $12 with 0.14, and we will get $85.71. So this is the present value of this preferred share. Another feature of a debt instrument is its convertibility. When we talk about a convertible debt or convertible security, in this case we are talking about a debt security. So if it has a convertible feature in it, that means that this debt can be converted into a common stock after certain time or after a specified time period. So convertible bond, when we talk about convertible debentures, so these are unsecured bonds or loan, often and with no underlying collateral backing up the debt, because the debentures are unsecured kind of bonds. So these convertible debts are long-term debt securities, and they pay interest return to the bondholder like any other bond. But the unique feature which is of these convertible bonds is that they are exchangeable for stock at specified time period, and they will give a bondholder a certain kind of security that may offset some of the risk involved in investing in if it's an unsecured bond, or so in unsecured kind of debts. And convertible bonds are actually a type of hybrid financial products which have features of both debt and equity investment. And in the investor who is investing in this convertible debts are have a security of earning a fixed amount of interest while bond is active, and it have the option that you can convert these instruments into equity if the stock price rises over time. Now, when comes to valuation, so as if we have a convertible bond, so it has two feature in it. As one, when we are getting return from it in a form of debt, and secondly, it has a convertibility option as well. So we have to also consider its convertible value, converted value. This is known as the formula value. So as when we are considering the value of this kind of debts, we have to consider the convertible value which are we getting from that debt. So in that case, we have to consider different option. First of all, we have to consider the floor value, and floor value is market value without the conversion option. That means that we have to take the present value of future interest and redemption value, like we have done in the previous questions, that we have considered that what amount of interest we are getting from that security and or debt instrument, and what amount of the total value which we will get after the or as in a form of redemption. We have discount it at the their required rate of return, and we have added all the amounts, so we get the present value of all future cash flows we are getting from that security. So that amount is called as or that thing is called as your floor value. Then once we have considered we have calculated the floor value, the second thing is their conversion premium. The conversion premium is market value minus the current conversion value. So in this case we can see the convertible value for the debt. That should over here we have asked in the question is that should investor convert if the share price is $4, $5 or $6. So first of all we have to find out the value of that instrument if we are not if it is not converted into shares or equity. So we will use the same formula which we have used for redemption of debt instrument. So in this case, this bond will provide you 8% return per annum, and after that they will give it will be redeemed dollar 100. So first of all we have to find out the value of interest per period of time. So we can use the annuity formula, and with the help of annuity formula we have dollar 12 as R, and I would be 0.08, and the number of installment are 5, so we'll get the value 47.916. And redemption that which is $100 after 5 years, so we can use the simple present value formula, like we have divided $100 divided by 1.08 power 5, so we'll get 68.100, and we added the both of them and we'll get 116.016. That is the value when we have not converted that note into shares or common stock shares. Or after that they have asked us that at what price it would be favorable for the investor to convert its bond into uh, into common stock. So we because the conversion terms are that you can convert one debt instrument or one note into 20 shares. So in this case we have to multiply market value with 20, because one this debt note is equal to 20 shares. So if we will multiply 4 by 20, so we'll get $80. But this amount is lower than 116, so we can it's not profitable for a investor to convert its debt instrument into this common stock. In case of $5 market value, the value of this bond would be $100, and in case of $6 it would be 120. So 120 is a good time, and it's good option that you could convert your debt instrument into common stock. But if the market price of equity rises to $6, the security should be converted. Otherwise, if it is more than than as debt. The break even conversion price is dollar 5.80 per share. That means that in this time you will know the investor has at an indifference position, because both in case of debt instrument, in case of equity instrument, your price where you will getting the equal amount. So we have got this amount by dividing 116 by 20, so we'll get 5.80. So the value of the conversion will therefore be 116 unless the share price rises above 5.80, at which point it will be the value of the equity received on conversion. So if rises to the market value of equity rises from 5.80, so it would be beneficial for the investor to invest in this converted security and convert it into equity. Now, there is another question through which we can explain the market value, floor value, and conversion period. So, first of all, PO Corporation has an issue of of 8% bond, which are redeemable at their par value of $100 in 3 years' time. Alternatively, each bond may be converted on that date into 30 ordinary share of the company. The current ordinary share price of PO Corporation is $3.30, and this is expected to grow at 5% per year for foreseeable future. The debt holders of PO Corporation requires return is 6%. So we are over here. I have required to calculate current values for each $100 convertible bond, and the bonds at market value, floor value, and conversion value. Now, looking into the solution, we can see that first of all, we have to find out the market value, and the market value, as it is seen that in question they have suggested that it is expected that there would be 5% increase in the market value, and the current market value is 3.30. We multiply it by 1.053 in order to get the market value after 3 years. So we'll get 3.83. Now, in order to find out the conversion value, that is 3.83 multiplied by 30, that is 114.60. So if when we see that if the bond would be redeemed at $400 par value, so it's preferable that the company for that the investor should convert that bond, because the conversion value is 114.60. And the current market value will be, if we want to find out the current market value, so the current market value will be the present value of future interest payment plus the present value of conversion value discounted at the debt holders return of 6%. So in that case, we can find out the present value of 3 years in 3 years coupon rate, that is 8%, and discounted at discounted at 6% for 3 years. And for second, we can see that as the conversion value is 114.60, so we will discount this conversion value for 3 years. We'll get $21.38 plus 96.21. We'll use the same formula as they have in this slide. We have used the table formula, in which we have multiplied with the discount factor with the values, but you can use your own formula by simply discounting $8 for 1 period and for 2 period and for 3 period, and add it up. We'll get the value 21.38. The same will be done with the conversion value, like 114.60 divided by 1.06 power 3, we'll get 96.26. Then the market value of this bond is 114.64. Then the floor value, as we have seen that in the floor value, we'll see we will not we will see the redemption value and the present value of all interest payment we'll getting from that security. So the current floor value will be the present value of the future interest payment plus the present value of the redemption value. So over here, the interest payment is $8 per year, and the redemption value is $100. So over here, what we do is discounted at the debt holders return of 6% per year. A floor value would be $100 multiplied by 8%. Like, we can only say that 8 when we will take $8 and we find out the present value for each period. Like, for first period it will be discounted for 1 year, for the second period it will be discounted for 2 period, and for the third period it will be discounted for 3 period. period. And so we'll get the value 21.38. But in the case of the redemption value, we will take $100 and discounted it for 3 period by taking the discount rate, or we can say the required rate of return of 6%, and we will get the value $54, and the floor value would be 105.38.